Alrighty, folks, this is the 26th video of the Maybe series and the 6th under LBOs. And in this video, we're going to be talking about how a PE firm exits in an LBO, right? So let's say that the 5 years are up or whatever period that they decided, right? And now they want to exit from their investment, right? And essentially pull their money out and pay it out to their partners, right? So how exactly does that look like? So I'm going to rank these from kind of the most common to the least common, and I'm going to give a little bit, a couple of like points around each one, right? So the first, and this is probably the most common, and that is a strategic sale. Strategic sale, right? Normally these happen to corporate buyers, right? So think about maybe a PE firm invests in a technology company, and after a period of time, they've done what they can to improve the company over that 5 years, and now they're going to sell it to Google or they're going to sell it to Apple or something like that, right? So a strategic sale is good because typically these corporates can they can typically pay a premium, right? So they're able the PE firm is pretty happy with that because they're able to essentially make a pretty penny on that sale, and then it's also kind of ties in with like those cost synergies or the revenue synergies that those corporate buyers can essentially capitalize on, right? So they're able to pay this premium because they can kind of capture all of these like different synergies, right? This typically makes the PE firm pretty happy, right? So the PE firm is pretty happy in this scenario, right? They were able to get a good return on that investment. Now let's look at the second case, right? This has become more common, but this is a sale to another PE firm, right? And this is a little bit less attractive because essentially one private equity firm has already touched it. They've improved it to whatever degree. So the second one might be a little bit more skeptical in terms of how much more growth can they squeeze out of this company, right? But then at the same time, I mean, maybe you can have like just some like continued growth or something like that, right? And the other PE firm specializes in one specific area, so you kind of have that continued growth. So this is really common. So this is really common today, right? Another way is through IPOs, right? So essentially, a PE firm can take this firm public and then gradually sell those shares in the open market, right? So this is slower. So some PE firms don't like that the fact that it is slower. It's also a little bit more difficult because you have to kind of take it public, and there's a bunch of things to do there. But I mean, maybe if they think that the public markets really favor this company, then it's something that possibly could occur, right? But it's not like the first thing that I guess these PE firms reach for. The fourth is what's called a dividend recap, right? So a dividend recap is something kind of peculiar to the private equity space, and that is it's not a full exit, right? So it's not a full exit. It's actually partial, right? So the company typically takes on new debt and it pays out a dividend to the private equity firm, right? So it's like paying its shareholders, right? Where the shareholders are kind of the individuals in the private equity firm, right? So it still owns the company, but it's returning some of that money to its shareholders. And this typically happens kind of in the mid uh, period of the holding period in terms of timeline, right? And then the last one is kind of a worst case type scenario, and that is like a distressed sale. a distressed sale, right? So there, here they might kind of look for a market to kind of sell off the assets. Typically, if there's a distressed liquidation type situation, we're not really going to have like a restructuring unless there looks like there can be some help here, right? That can kind of turn things around, but that's also like a potential like option at this point in time, and this is like the least desirable for the private equity firm as well, right? So if you really think about it, I mean, it's relatively intuitive, right? The best case scenario is that you're able to sell this company to a strategic buyer that's willing to pay a premium because they can kind of capture these synergies. Then, if that's not possible, then they would sell it to another PE firm, right? This is also good because you're typically selling to a sophisticated buyer. They kind of know what they're getting into. It's typically very efficient, a bit quicker, and this is something that's been happening more and more often these days. The third is an IPO, so of course that's slower, but then there's really big upside. There's also once you take a company public, there's a bunch of regulations and stuff like that, which is a little bit of a headache, right? And then something else that private equity firms have been doing is a dividend recap, right? So they'll essentially take on new debt, they'll pay a dividend to the like the PE firm, and then this typically happens in kind of like the mid period of the holding period, right? And then lastly, if things go really, really poorly, they might have to restructure. They might sell off the assets and just sell it at a pretty low valuation, right? So of course the PE firm isn't happy with that. So that's kind of an overview of the common exits in LBO. I don't think that they would ask you anything beyond this, and having just a really high level understanding of how these exits occur, who they are too, what it looks like, what PE firms like, what they don't like, is I would say good enough for investment banking interviews. So I hope that's been helpful, and yeah, we'll hop into the next one.